Thinking about becoming a property owner in Japan, or are you already one? Becoming a property owner comes with a lot of responsibilities, and one of them is tax. And that's today's topic. In this video, I'm excited to show you what to keep in mind about Japan's real estate taxes and share some tips that can potentially reduce your taxes legally using depreciation, deductible expenses, and some smarter filings. And these tips can apply to both resident and non-resident foreigners. Hello, I'm Toyo Tanuma. I'm the founder of Open Room Inc., which is a Tokyo-based real estate startup that helps foreign buyers to purchase properties in Japan and manage properties on their behalf. I have over 10 years of experience in real estate finance and investment banking, and also another 10 years in advanced technologies, things like AI and software building as a tech startup founder. So if you need my help, please contact my team. You can find everything you need to know in the description of this video. Okay, let's start with the good news. Japan allows a wide range of deductions against rental income. That means lower tax for you. Here's what you can typically deduct: property management fees, maintenance and repairs, annual property taxes, fire insurance premiums, loan interest, real estate agent commissions for any leasing activities, and the big one, depreciation. Depreciation lets you deduct the wear and tear on your building over time, in most cases for wooden structures up to 22 years. For metal and light steel, anywhere between 27 to 34 years. For what they call as RC or SRC, which stand for reinforced concrete, and steel reinforced concrete, up to 47 years. Let's keep in mind that land is not a depreciable asset. It's only the building that you can depreciate over time. Let's say you buy a 50 million yen residential property, which is roughly 300 to 350,000 US dollars. If 50% of that value is allocated to the building, which is 25 million yen, then your annual depreciation will look like this. So depending on the building structure, you can reduce your annual income tax by a few $1,000s, which is pretty significant. Even if you don't live in Japan, you can claim these deductions, but only if you file a tax return. So, how is rental income taxed for non-residents? Rental income from property in Japan is classified as Japan-sourced income, meaning Japan has full taxing rights over it, regardless of where you live. By default, a 20.42% withholding tax will be applied. And if you don't file a tax return, you'll be subject to paying the full amount. No deductions, no depreciation, just 20.42% taken off from your gross rental revenue. However, if you do file a tax return, you can deduct your expenses and depreciation, possibly reducing your taxable income down to zero or even negative if the expense exceeds the income. I'll go into more details about this in the upcoming case study section. Now that you've learned about depreciation and rental income tax, let's talk about when you sell the property. In Japan, capital gain tax depends on how long you've held the assets. If you sell within 5 years, the capital gain tax of roughly 30% is applicable. But if you sell after 5 years, that goes down by half, roughly 15%. And this is calculated based on the difference between your purchase price and selling price, minus any acquisition and disposition costs that you have incurred. Things like any third-party fees such as brokerage fees and renovation costs. Quick tip, the key date is January 1st of the year that you sell. For example, if you bought land in May 2019 and sell in September 2025, as of January 1st, 2025, you haven't owned it for full 5 years, so you'll be taxed as short-term gain, which is 30%. Whereas if you bought land in December 2018 and sold it in September 2025, by January 1st, 2025, you've owned it over 5 years, so you'll be taxed as long-term gain, which is 15%. So this 5-year rule of January 1st is very, very critical. So plan your timing wisely. If you are non-resident, you must appoint a tax representative, known in Japanese as a nouzei kanrinin. This is a legal requirement. Your tax rep handles filings, receives tax office notices, and acts on your behalf in Japan. Usually, it's a local accountant or someone you can trust who resides in Japan. And if you don't have one, your property manager may be able to appoint someone for you. Now that you have covered the basics, let's walk through a quick example. Let's say you buy a 50 million yen apartment in central Tokyo and you rent it out for 200k per month. That's 2.4 million yen per year. And you paid expenses of management and repairs of 400k, property tax of 240k, building and structure depreciation of 530k, loan interest of 250k. That works out to total deductions of 1.42 million yen. And if you subtract that amount from your gross rental revenue of 2.4 million yen, you end up with a taxable income of 980k. And let's assume your home country has a tax rate of 24%. That means your tax would be 235,200 yen if you file. But if you don't file, you'll pay 2.42% on the full 2.4 million yen gross revenue, which is around 490k. That's a difference of more than 250k just for not filing. So yes, managing your tax matters a lot. Okay, so as you can see, owning a property in Japan as a foreigner doesn't have to mean overpaying taxes. With smart planning, using deductions, depreciations, and proper filings, you can keep more of your income. If you found this video helpful, please give it a like and subscribe for more tips on purchasing and investing in Japanese real estate. Any questions or need help on finding right agent, property manager, or tax representative, drop a comment or email me directly at contact@openrm.jp. Thank you for watching and I'll see you in the next video. Sayonara.